let's talk a little bit about the markets today. The market wrap's only going to take half as long as it does normally because we only open half a day. The markets opened up this morning very nicely, and we're actually trading okay this morning, getting some follow through from yesterday's rally, which we had talked about last week. We said that was likely and that we would get a bounce off support. And you know, we've been talking about this support here of late, right along the bottom of this support line, which is the 100-day moving average. The market's been holding on to that extremely well, which is good news. That continuation of building of support at the 100-day moving average gives us confidence that we're going to be able to hold these levels here, hopefully longer. Now, the problem was, though, at about 9, 10 o'clock this morning, China came out and said, well, we're not going to allow Micron as part of this whole tariff war thing that we're involved in now, this trade war. China said that, well, we're not going to allow Micron to import their chips into China. Well, that hit the tech space really kind of all across the board, and everything that was green immediately went red. And we actually finished the day down about 13 points on the S&P. Now, we didn't give up all of yesterday's gains, which was good news, but we are back below the 50-day moving average, and we did retest support today at the 100-day. Now, I said yesterday, don't worry too much about what happens this week in the market. Look, nobody's around. Today was half a trading day. Nobody's going to be around tomorrow at all because the markets are closed. Thursday, they're still going to be out down in the Hamptons doing whatever they do in the Hamptons. Friday, they're going to be lazy. So nobody's really going to get back until next week. So what happens between now and Friday? Really don't pay much attention to it. We're not going to make any portfolio changes this week. We're still holding about 50% cash and fixed income in our portfolios. We're underweight equities right now, and we haven't added any exposure to our portfolio because we still remain range bound within this very tight consolidation pattern that we've really been in since early May. I just wrote yesterday on our Technically Speaking post, which is on the website now. Sorry, it's out today on our website today, talking about the year in review. And the first 6 months of the year, the S&P returned 1.67% on the S&P, not including dividends. If we make that a 60-40 allocation model, bonds were down about 3% year to date, which means that a 60-40 allocation has a negative 0.2% rate of return right now since the beginning of this year. Now, what that suggests is that even once you add in dividends and interest income, basically a money market's yielded about the same as what the market's done since the beginning of this year. Importantly, though, the things that we're talking about in the article today, though, is what to expect for the rest of this year. And our expectations remain pretty flat that we're going to be still confined to this big trading range that runs from the previous market tops at about 2,800 to the previous market lows, which is down around 2,600. So we're going to be stuck within this range most likely for the rest of the year. Any breakout to the upside will likely have a lot of trouble penetrating much higher than recent highs, and any break below the 200-day moving average is likely going to retest the lows of the markets from January fairly quickly. So again, while there's not a lot of upside, this is the problem with the market right now in terms of making investments. The risk reward on the market right now where it sits is basically even up and down. It's a coin flip as to what your return is going to be if you invested today. This is why we talk about risk management most importantly, but also allowing the markets to tell us what it wants to do. If it's a 50-50 coin toss between making money and losing money through the rest of this year, why not wait until the market tells us it wants to go higher and then get on the train at that point? And that's kind of the way we're looking at things right now. The risk reward simply is not in our favor enough to really warrant taking on a lot of excess risk within portfolios right now. We are lining up a big list of buys, though. I mean, we've got a nice shopping list of companies that we want to own, but none of them are really performing well right now in terms of creating real risk reward opportunities to warrant adding capital into them. So we are watching them. There's some great companies out there that have gotten a bit cheaper as of late, but understand that when I say that, that is only relative to the short term because every company right now, for the most part, is overvalued. Trying to find true value in this market is a very, very difficult prospect considering that we're 10 years basically now into a bull market. Valuations are elevated. This is one of John's big arguments about the valuation of stocks and the markets in general. And again, the reason that we invest, and we invest long term, is to buy value. We want to buy when things are cheap and sell sell them when they are dear. And right now, finding things that are cheap is a very, very tough prospect in this market. And you got to be careful with companies like GE. People go, oh, GE's cheap right now. Well, there's a difference between being cheap in price and being a good value. And just because a stock is cheap in price does not mean it's a good value to buy. Sometimes things are cheap because they're meant to be cheap. And so you've got to be careful about where you're investing money and what and understanding valuation measures, etc. So pay close attention to what's going on in the markets here. There's a lot of risk currently present in the market. We've talked about this a lot. I went through a lot of the risk reward today in the Technically Speaking post. It's on the website. So simply go by the website, realinvestmentadvice.com, download the latest report. And look, we talk about risk management a lot, and I know it kind of goes over a lot of people's heads, but look, the bottom line is simply this. You've got to manage the risk in your portfolio. If you lose a lot of capital, you don't have time to get it back. And if you don't have a risk relationship and a risk management philosophy, I certainly encourage you to get one, or simply give us a call. We can help you with it. Simply go by our website, realinvestmentadvice.com, send myself or Richard or John or Danny an email. We are more than happy to help you and help get you doing the right thing with your money over time. Also, if you download our Technically Speaking post today, you can actually see our investing manifesto, which is basically our risk management rules that we follow for managing portfolios for our clients. We'd love to work with you too. Simply go by the website today, realinvestmentadvice.com. We'll take a quick break. We're going to come back. I want to wish you a happy 4th of July. More of the Real Investment Hour coming up next.
Get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.